So we're going to look at Chapter 8. Chapter 8 is titled Cash Fraud and Internal Control. And basically there are three ideas. We want to control cash. As the accountant, it's our job and our duty to make sure that the assets of the company are properly protected. Cash being the most vulnerable of our assets. We also want to set up internal controls so that cash cannot be taken without effort or subterfuge or thievery. And then thirdly, we want to know how to account or count the cash that is supposed to be there to keep in the records. So we're going to talk about who does what in internal control first. Then we're going to talk about a way that we can set up cash in an office, such as petty cash. And then I'll show you how to do a bank reconciliation. So I'll probably have to break the videos down into 3 or more small videos because 1, YouTube likes them in shorter clips, and 2, it's easier to get each subject into each different video. So we're going to start out in the very beginning. So we're in our book on page 290, 289, 290, the beginning of chapter 8. So the purpose of internal control is what we talk about first, and basically it's to protect what we have. We want to make sure that we protect the assets and control who has access to them so that we have them for later use. Accounting reform came about in early 2000s after something called the Sarbanes-Oxley Act, and it was because the biggest accounting firm in the USA today at that time, Arthur Andersen, were the accountants for a company called Enron. Enron had widespread accounting fraud. There have been movies and documentaries and a lot of things written about the fraud at Enron, but the accounting company who was supposed to be there in protecting the assets or helping the company protect what they have was complicit. They were guilty of that fraud at the same time because they helped Enron cover it up by reporting false financial statements. And this was all discovered by a junior accountant at the company Enron, reported to her bosses, and later she was fired for it because she pointed out the irregularities and the illegalities. So you can read all about SOX. We refer to it, but it changed the way the U.S. government looked at and controlled accounting work. So today, we are overseen by the government, and we are required to have auditors who verify company standards and their reports that are separate from the accountants who do the company's business accounting. These auditors are accountants. They're special people, and they have to be paid for by the company who's having the audit, but they're not allowed to be employees of the company and not allowed to represent the company in any other financial statement measurements. And that is our biggest change. So we carefully oversee now to make sure that the fraud that happened at Enron does not happen again. This also caused great economic collapse for our country, and many other companies fell as a result of this scandal that started with Enron. Other companies that were handled by Arthur Andersen, as well as other accounting companies. Arthur Andersen, by the way, no longer exists. So we have a committee for controlling fraud. You can read about that on 289. And then in 290, we're going to go on and talk about what we do to control money at a company. So first of all, as the accountant or the company, one of your main jobs is to establish who's responsible for what, who does what, and who has access to the fraud, the cash, and other assets that can be stolen in the company. So each person should be assigned those duties. In other words, you shouldn't have the clerk come in, take the cash, and also be responsible for locking it into the safe at night and knowing the combination of the safe. That's bad management. Good management says one person takes the cash in, another person counts the cash that was taken in, and either he or a third person locks it up into the safe at night so that no one person has total control over the flow of the cash that's collected throughout the day. We also, as accountants, have to establish and keep good records. Good records show us when money comes in, when money goes out, how it's spent, how purchases are made, how orders are submitted, all of that. So a paperwork trail to go back and find out who did what is pretty necessary. You want to make sure that assets are insured. So, for instance, you need company insurance for the computers and the equipment in the office. But you also want to insure the employees who work for you. If you have employees, as an example, who go into homes for cleaning, you don't want those employees not to be insured in case there's items that go missing or the client accuses your company of having items stolen from his or her house. So you have to bond those employees. Bonding is a process where their background is checked, their credit is checked, and the bonding company, which is an insurance company, ensures the reliability and trustworthiness of that employee. You're going to divide up jobs and related transactions, as I've already said. Cash coming in shouldn't be also recorded in the books in the bookkeeping as cash by the bookkeeper. That should be two different things, two different people. In small companies, when there's only one or two people doing the work, this isn't always applicable, but we're talking about companies with at least 5 people in them, 5 up to 100, up to 2 or 300. You want to use technology because technology helps us do things like digital time stamping, electronic record keeping. It's pretty automatic, it's pretty painless, and almost every company uses some sort of computer system today. So digital tools help us do that and do it better. Those digital tools could include things like apps on the phone for when employees get to work and they just use the app to clock in or report the time that they work during the day. Clock in, clock out for lunch, clock back in from lunch, clock out for the evening. And you have a digital record that is transmitted through the cloud via smartphone, which works really nice. You're going to want to, as the accountant, to conduct periodic reviews of all of these procedures that you put in place and make sure that they're being followed. And if they're not being, you want to have sort of a meeting and review the procedures. And then if you need to, you want to go one step further for that and then have an employee sit down, review about the violation of those procedures. In 291, we talk about the technology, the fraud, and the internal control. Why technology? It keeps processing errors from happening. So we know we use our brains to add or subtract or multiply or divide. We can get a pretty close answer many times, but we'll get a perfect answer if we put the numbers in using calculations in a calculator or spreadsheet. It just takes away the risk of error. We want to make sure that we separate the duties of the different people. I've said that, twice now. Some employees may not be trustworthy with some areas, such as cash, but they're very good hard workers, such as the menial job, stock clerks, for instance, in a grocery store. Might not be trustworthy at a register, but you do need somebody to put items out of the boxes and onto shelves. All right, so what are some of the limitations, bottom of 291, of internal control? Again, we go all the way back to chapter 1. We have the fraud triangle that we talked about then. We have opportunity, we have pressure, and we have rationalization. Opportunity says the cash is there and they can take it. The rationalization says you don't pay me enough to do this hard job that I have to do and put up with all the crap that comes at this job, and I feel like I deserve better. And the pressure comes from internal or external pressure for more money. You want better things, you compare yourself to the neighbor, you have bills that you can't pay because you've gotten so far into debt or other things that you really think, they got all this extra, it's just sitting there laying around, I might as well help myself to it. And I keep talking about cash, but there are other assets that can be stolen. We might think of these as office supplies, or if you work in a medical office, drugs or drug samples. They were given to the doctor, and he's got hundreds, so why can't I just have a few of these samples or whatever? We want to make sure we're protecting every environment that we work in best we can. Okay. So, now we're going to talk about cash management. 293. Cash management simply means that we need to plan best how to spend and save the company's cash. Cash management is not paying the bill the day that you get it in the mail, but waiting until the cycle of bill payment is due. For instance, you and I get our electric bill in the mail and we know when it's due, and if we were to run down the day it came to us and pay it, we might take 10 or 15 days of that interest that we could earn and rob ourselves of that because we paid the bill too early. So this works the same in companies. When a company receives an invoice or a bill, they want to put it aside, make note of it, and make sure that it is paid, but we do not want to pay it too early because we'd lose interest on the money that we have sitting in the bank, drawing even a money market savings account rate or a low interest rate, savings rate. So we want to pay the bills when they're due, before they're due, take advantage of the discount if there's one offered, but don't pay them so early that we're robbing ourselves of any interest that we might be earning beforehand. Only keep what is necessary to run the business. That means if you have outdated equipment that you no longer use, it needs to be discarded or donated. If you have things that are taking up space, rather than hang on to them for whatever reason, sentimentality is usually the first reason at home that you keep something, and then secondly, you just don't have the means necessary to know what to do with them or how to dispose of them. Like old electronic equipment, it's hard to get rid of old TVs if you don't know where you can safely donate them, or old computers if you don't know how to take care of them. But you only, as the accountant, need to keep what's useful to the business. And useful means it helps us to make money or sell our product. Not the other way around, not sentimental. If a company has excess cash sitting around in the bank or the checking account, they've had a good year, they've had a good couple of months, they've been really careful, then all that cash shouldn't just be in a checking account or a money market. It needs to be invested so that it helps the company earn money later. And an investment advisor is the best way to do that, but the accountant should recommend that that excess cash to the business owner needs to be drawing a better return for the business than it does just sitting in the checking account. So when we have over-the-counter cash receipts, that means money comes into the business. What do we do with it? We take it in either at the sales department or the register. So think of the retail store somewhere like Belk's or Penny's or Walmart even. We take cash in. So if we make a sale, the cash can come in as a cash sale, or it can come in as an account receivable sale, and we'll send out the bill and the client will pay us later. So when that cash comes into the counter, we have something called a cash short and over, and this is just basically the difference in what the electronic record of the cash register says we're supposed to have in cash versus what we actually have in the drawer when we count it at the end of the shift or the end of the day. So on 294, you've got an example of how we take care of that cash difference, if there is one. Now, when you bring up the day's sales and the register tells you that you should have $550 in sales, you'll see from the journal entry, $550 sales, but you count the drawer, and the drawer actually has $555 in sales, you're $5 over. So you'll have to make a debit entry for cash for what you took in, a credit to the cash short and over account. So this is one of those accounts that we use either when we're short or when we're over. We just have to know which way to put it. It can be a debit or a credit. Because we were over, we give it a right-hand entry credit, and that's a $5 cash over. So then we record sales at $550, which is the tape tells us we should, and a cash debit to $555 because that's actual cash that's in the drawer. The opposite is true for when you're short. If you look at the next example, our tape told us that we had $625 in sales this day in cash, and then we count the drawer and we've only got $621, so we're $4 short. So we record cash for what it really is the debit, $621. We a $4 cash short and over debit because we were short, and then a $625 cash credit for sale. Oh, sorry, not cash credit, a credit for sales. All right, so for cash short and over at the table or at the counter, we take care of it with a journal entry. It's just really an adjustment to the amount of cash that was recorded as coming in. If we take care of cash coming in through the mail, then there should be a whole process, and there should be at least 3 people in the process. So the first person is going to be someone who rings up the sale. We don't really count them because that happened in the store. The second one is going to be someone who works in accounting, and they receive the mail. So they open the mail, and they take the check, and they compare it in the record to the amount that was owed, and then they would apply the payment. When you're working in a company, these are often advertised as account receivable clerks. And if you're on the other side and you're ordering company products using company money, you're an account payable clerk. This job starts out about $18, $20 an hour right after you get out of school with us. All right, so they take the cash or the check and they apply it to the payment. And then at the end of the day, they bundle up all the payments that they've received or applied, and they pass them on to someone else, someone in a higher position to them. That person then would take all of that money and add it up, verify that it was all done correctly, and then deposit it into the bank account. That person is usually the company accountant or the company treasurer. All right, we're going to stop here now. Next video, we'll cover the petty cash system.